Thank you for joining us. The following presentation is from a webinar titled Year-End Construction Industry Update, originally produced on October 22, 2015. The presenters are David Blaine, Michael Hoffner, and Mike Eby, all with McKonly and Asbury. Enjoy the presentation and visit us online at www.macpas.com for more information about our future events and upcoming webinars.
Thank you very much. My name is David Blaine. I'm a partner at McKonly and Asbury. I lead the construction group and the construction practice here. With me today is Michael Hoffner, who's a partner in the firm as well. Handles a lot of construction and manufacturing clients for us, and we'll be talking a little bit about our A&A update. And Senior Manager Mike Eby will be giving us a little bit of a background on what's going on the tax side. I have to start by saying I feel like I'm in the press box here at a Phillies game with two of my colleagues here as we give the announcing of this activity. So I'm going to turn it over right away here to our first presenter, which I believe is Mike Hoffner. He's going to give us an A&A update.
Very well. Thank you, David. And as David and I were speaking in preparation for the webinar, one of the things that became very evident as we look at the body of technical literature that's come out recently is that a construction industry update for accounting and auditing has one of two directions it could go. One is about 10 minutes worth of really global high-level update that won't let you get into any good details, and the other is about 6 hours where we do a deep dive into things. So we chose the former because David warned me that nobody wanted to listen to me talk for 6 to 8 hours. So start off by saying very simply that we don't have enough time to do a deep dive. We don't have enough time to get into the nuances of some of the technical pronouncements that have come out. So we're going to focus our time on just a few key areas. One of those being an update on where we are on the revenue recognition project, something that 3 years ago, was a really hot ticket item, particularly in our industry, and some of the potential impact of that exposure draft on contractors, and has settled down a little bit, but still some things to talk about today. I want to talk just a few moments about a leasing project and something that once was dead and now is back, and something we should be very aware of. And then finally, just a few minor disclosure items and things to be aware of as they come down the pike. But I will certainly reiterate and clarify that there's a lot of technical literature in process, a lot of new pronouncements that have come out of FASB. And we just don't have time to talk about them today. So please don't take this 15 minutes as gospel for what you need to know and all you need to know for technical accounting in your business, and take some time to dig into further detail, or if you'd like to reach out to me, my contact info will be available, and I can certainly point you in the direction of finding some more details and granular exploration of some of the recent pronouncements. And then we're going to end our discussion with just a little bit of update on accounting and review standards, something that normally we wouldn't talk about on a industry webinar because it really is just relevant to the accountants. But you'll see some differences for those on the audio that have compilations and reviews. You'll see some differences in how your financial statement reports look this year. I wanted to just touch on that so you know what's coming. So we'll start with revenue recognition. If you remember back to 2011, 2012, when our early exposure drafts came out that changed the face of revenue recognition from what in the United States was dozens upon dozens upon dozens of pieces of technical literature and interpretation with many different industry-specific applications. The idea around the exposure draft was not only to try and get a little closer to global accounting standards and international standards, but also to essentially make the literature a one-stop shop. No more industry-specific details, no more 12 or 13 different places to go try and find an answer. We'll put it all in one place. And as many of you will recall, that first exposure draft, very simple for folks in kind of general industries, manufacturing, distribution. Two industries in particular, software development and construction, really reacted very negatively towards that exposure draft because it legitimately would have changed, if read as written, would have changed the way we recognize revenue in our industry. The construction industry cried out loudly. There were significant changes made to the exposure draft because of that. And as a result, we got a new exposure draft and a final document that was issued in May of 2014. The implications of that document are still fairly significant, but the good news is that we'll retain the ability to do something very much like what we've been doing for the past 30 plus years in terms of revenue recognition over the life of a contract. The words we use will change, some of the mechanisms we use will change, but that exposure draft and the final document did result in something very similar to what we're doing now. But a few things that we need to be aware of. There's a much more significant burden on the front end of a contract to identify what our performance obligations are. And I could go into a lot of detail on what a performance obligation is and how those are defined, something that we probably won't take the time or shouldn't take the time to do right now. But if we go back to that original exposure draft, the fear was a contract would be broken into 200, 300, 400 performance obligations. For example, I'm building a bridge, so a performance obligation might be putting footings in, and putting pilings in would be a different performance obligation, and then eventually I have a performance obligation to put decking on and to complete that, ultimately complete the project. And how do I define each of those and properly allocate revenue, et cetera, et cetera? The new standard does allow, let's say, that bridge to be identified as a performance obligation, but there might be pieces of that construction project that you really need to sit back and think about. Does it constitute a separate performance obligation, and how do I identify revenue associated with that? So something we have time to work on, and we'll get to the effective date here in just a minute. But things we need to think about. We need to think about documenting our conclusions on what that contract is, what it represents, and what we're trying to accomplish. A couple other things we need to be aware of. Transition guidance continues to evolve. Early on, there was some fear that the transition from the old way to the new way would require us to go back to all those completed contracts that might have been in progress during the transition period and figure out how to restate them. We're trying to get some clarity on that, and the FASB has put out some transition guidance that makes it a little bit simpler in terms of not having to restate those previous contracts, but they continue to put out additional interpretive guidance and transitional guidance. So whatever we say today over the next 2 years is going to become clearer and is on the radar screen for the FASB to continue to make sure we understand. There was some fear early on that cost to cost would go away, that we would now have to find a whole new method of identifying percentage and progress towards completion. Cost to cost still exists. We, again, will result in a lot of the same processes to identify the ultimate revenue that's going to be recognized. So a lot of good news on that final exposure draft, but yet a lot of questions that are still being answered. And I would say stay tuned on some of those. There's a technical practice group within the FASB that's working very diligently to make sure that all of those nuances are worked out over the next 2 to 3 years. The AICPA, the CFMA, all are actively paying attention to application of this new standard, knowing it has some broad-reaching implications on our industry. And so I believe we will continue to see some specifics come out, maybe not back to the point of a SOP 81.1 where we're talking specific construction accounting, but I do believe we'll see some additional clarification that will go back to making it clear what we're doing and how we're going to do it. A couple other things that they're being looked at as recently as end of September. Some new proposals came out on how we affect collectability in our ability to stop work for non-payment into our revenue calculations, how we consider non-cash consideration, transitional methods for completed contracts, as I said, continues to evolve, and then they've put out some practical expedients in theory to make our lives easier, although I'm not always sure they do. Other things to keep in mind, certainly there is still a lot of ability to interpret the standard in a way that might not be favorable to what you want to accomplish or what we used to do under percentage of completion accounting if you take a very strict interpretation, so be aware of those things. Again, outside of the scope of what we have time for to get into those nuances, but things like warranties, change orders, and claims come to mind as items that strictly interpreted might cause some headaches for for us as we go forward. From an effective date perspective, recently the effective date was pushed back by a year. For non-public companies, the standard is effective for fiscal years, reporting years beginning on or after 12/15/2018. That's 2017 for public entities, but 2018 for non-public. So, as I said, a lot of runway, a lot of time to figure out some of the implications of this, a lot of time for us to not only work through making sure systems are configured properly and we're using the right inputs, but also for us to work with fine folks like my colleague, Mr. Eby, on how some of these changes on the book side will need to be factored into the tax side, and make sure we do things the right way in terms of conversion from book to tax, so that our friends at the federal government and state governments can get their fair share of whatever changes are made. Moving on to leasing. Leasing is a topic that in 2010 came up, in 2011 went away, in 2013 came up. In late 2013, we really were under the impression might be dead, and here we sit. And today it is certainly back alive, and we will, in the next few months, have a final standard on leasing that we need to be aware of and paying attention to. I believe we'll have time to get the transition done correctly. I don't know offhand what the effective date will be when that final standard comes out, but we'll certainly have time. But some things to be aware of on leasing. If you'll recall some of the early discussions that were had both on our construction updates from the firm here and at other things you may have attended, the concept out of the original standard was simply this. We need to take leases that right now exist off the balance sheet, and right now we might have a 5 or 8 year obligation that we're considering an operating lease. So we have a annual expense and we're all good to go, and the concept being now that those leases belong on the balance sheet. We have a long-term obligation and we have a long-term commitment to use that asset, so we're going to put all those leases in excess of 12 months onto the balance sheet. Little bit different in theory than a capital lease as we think of it today. If we think of a capital lease today, we actually book that crane onto our financial statements as an asset, and we book a liability as a debt. The new standard would have us not book that crane itself, but book a right of use to use that crane. So it would actually be an intangible asset. And that intangible asset would be representing the long-term right to use a tangible asset. The other side of the balance sheet would be a liability, much like in a capital lease liability, but is an obligation to pay for the right to use that asset, not necessarily a debt instrument. So a couple things we need to be thinking about. One is the type of leases that we have. There's a couple things, I'm going to read off their terms, and you'll hear some similarities for those who remember going all the way back to FAS 13. Some of this stuff's going to sound really familiar to you. So the FASB has come out with a dual approach concept. So the first idea is that of a financing lease, which is they consider to be a type A lease. A financing lease is in simple terms what you used to think of as a capital lease. Here are the concepts in the expected final document on leasing. So to be a financing type lease, you have 4 criteria that need to be tested, and any of the 4 could trigger a financing type A lease. One is that the payments for the asset represent substantially all the fair value. Second is that the term would be for a major portion of the asset's life. Third is that you have a bargain purchase option at the end. And fourth is that title could transfer at the end of the lease. So any one of those 4. So if you think back to FAS 13 and the way we've been looking at operating versus capital for years, it's the same 4 tests. The difference is that the 90% and 75% tests, and I know, David, you're loving this level of detail. The 90% and the 75% tests will no longer be a bright line. So no longer will we be able to look at something that conceptually looks, smells, and feels like a capital lease, but a lessor has put us at a 89.5% of value, and so now we believe it's an operating lease. So it would be a little bit more judgment involved. The other option is a type B lease, which is very similar to an operating lease today, but you will have the balance sheet asset and liability to consider. So stay tuned on that. Final document will come out, and we will most certainly be including an article in our newsletter on the details of that when it comes out. So moving on, a couple things I want to hit just real high level. New disclosure items to be aware of. Balance sheet classification of debt is one to be aware of. The subjective acceleration clauses, there was originally some noise about how you factor the probability that those might be triggered. Now it's simply the classification between current and long-term debt. If you have a subjective acceleration clause, is when that clause is triggered. There's no longer any assessment of the probability. The bigger one, though, is waiver of covenant violations. There was some discussion of covenant violations. If you fail a debt covenant prior to your balance sheet date, so let's say calendar year end, historically, from an accountant's perspective, we've said if you get your waiver before we issue the financial statements, we'll still consider that to be long-term debt. But the revised standards actually said you have to have it before the balance sheet date. So if you don't get your waiver before December 31st, it doesn't matter if you get it in January. That debt would all still be classified as current. We've got a little relief on that based on what we're looking at here. And with that relief, you would still show it as a non-current debt because you got your waiver, but you would have to specifically identify and disclose that fact. A couple other things. Consolidation of variable interest entities. This is an old one, but bears repeating. If you have common control leasing arrangements between two companies, in the old rules and the requirement was to consolidate. Now, in a private company perspective, we can revisit that. So keep that in mind as you go towards year end this year. And then finally, I've listed there some disclosure projects that are underway to be aware of. None of these are at the stage of an exposure draft or a final document, but things that in theory should help clarify and in some cases simplify the ever-increasing disclosures that were required in financials. So some good news there, I hope, and some good news on how we look at things like fair value and income taxes and making sure that the disclosures are clear and concise.
Mike, quick question for you on the VIEs, just very quickly. In regards to the consolidation of those entities and in the new language that's out there, anything if you are on a tax basis of accounting, that would still not apply, correct?
Correct. In tax basis, you would still follow the tax consolidation decision tree. So that's simply for book. Good question.
Yep.
So I want to close this very, very brief update on book and on accounting with just a real high-level introduction to some new requirements in the public accounting world on compilation and review engagements. We historically have run under some standards that caused a little bit of lack of clarity in two fronts. One is as we get into a world where accountants tend to help their smaller business clients more and more on bookkeeping and financial accounting, the old compilation standard often forced us to think through whether we need to be issuing a compilation report because we as accountants were hitting print on bookkeeping we were doing, and we were actually handing clients or emailing clients financial statements that we printed, we published. And the way the old standards were written, that actually would imply that a compilation report would need to be done, which takes more work on our side, tends to generate more cost for our clients. And in today's day and age, with cloud-based accounting and more reliance on accountants, there was a need for some change to that standard. So we now have, as you'll see on the slide, what's called a preparation engagement. A preparation engagement is really to speak to those ideas of we are helping with bookkeeping, we as accountants are helping a client prep for another firm to come in and do a review or an audit. We're working in that back office perspective. And there's really no need to put together a compilation report. And so now there's great clarity on the fact that we can hit print. We just have to put some disclaimers on the financial statements themselves that say we're not providing any assurance. So no longer is there a report. And you can engage your accounting firm if you don't have a need for a compilation report, whether that be through a bank or a bonding agent. You can engage for that kind of an engagement, which is just a little bit simpler. Compilation reports now will still be following the same guidelines and rules in terms of what we have to do, but just as an FYI, the report itself is going to look very different. It used to get a little confusing in the public's mind because a compilation report was structured very much like a review and an audit report, and there was a little bit of ambiguity in terms of not knowing what I'm getting. Compilation report now it will actually look very different. So be aware as you see your financial statements, if you do engage your accountant for a comp, that they will look different and have some different language in them, but the service level itself is very much the same. The last piece is reviews. Not really a lot to talk about there. Again, the report itself will look a little bit different. It will include some headers now. but not a whole lot of change on the review standards themselves to be aware of. But I do think it's important for those who have lived in that comp world in the past few years to understand that things will look pretty different this year.
Mike, just a quick comment on that. I would think it would be important if you have a debt structure with a bank, and the debt structure with the bank requires annual reporting. Let's say it's reviews and maybe quarterly reporting of compilations, that they revisit that debt structure and the language there with their banker, because they may have the ability to get away from actually having an accountant prepared compilation and go more towards the internal prepared financial statements that that are shown by an accountant who prepared them.
I agree, and I think that conversation with your lender is warranted on two fronts. One is exactly what you said, David. The other is making sure that they're aware that things will look different. And I think there's an opportunity that we've had in a number of cases to talk to lenders in our network and make sure they're aware of these changes, but we have not gotten to all of them, and other firms have not as well. So I think you're right. It's a great conversation to have, and that conversation not only could open up some clarity on what to expect in terms of a potentially different report, but also avoid any question that your lender might have when you hand them something that does look very different from last year's report.
Absolutely. Mike, thank you very much for your time there. We're going to turn it over now to a tax update by Mike Eby, a senior manager at McKonly and Asbury. He's going to talk a little bit about federal and state tax and what to expect here at year end. I know there's a lot of participants on this phone that are very interested in Section 179, 179D, and bonus depreciation, and maybe Mike can give us a little bit more clarity on that. So, Mike, why don't you take it away?
Thanks, Dave. I do want to, before we delve into business here, address one of the comments you made at the beginning of the presentation about being in the Phillies broadcast. I want to remind you it's October, so typically the Phillies broadcast booth is empty at this time of year. So I just wanted to kind of
Mike,
throw that out there.
Mike, that's a great point. That's a great point. We could say that this is the New York Mets broadcast booth. I don't know if there's any Mets fans out there since this is Central Pennsylvania, but maybe we'll go that route. So, Mike, why don't you take it away from the broadcast booth here at in New York?
All right. Well, thank you, Dave. Obviously, I'm just ribbing. The question that we often get as tax practitioners at this time of year is, what's changed for tax? And usually at this time of year, the answer is the same. Yeah, there's been a lot of changes. But in a couple months, we might be back to where we were in the previous year. And we've been down this road the last 3 to 4 years. And I think the major second question that we get for that is specifically, what's up with depreciation? This is one of the larger single line items on a business taxpayer's tax return, and can often swing taxable income dramatically at the end of the year. For the last number of years, taxpayers have been able to take advantage of accelerated depreciation in the first year of placing an asset into service. In the case of bonus depreciation, that is completely gone as of the end of December of 2014. And for Section 179, that's now greatly diminished the benefit of that. So just to give you a little background on bonus depreciation, we'll start with that one. It came about in 2001 as a economic stimulus during that year. And when it came out, it was originally 30% of the cost of the asset that was placed in service that you could take as accelerated depreciation in the first year. That lasted to the mid-2000s, went away for a few years, and came back in 2008 at 50% bonus depreciation. That's gone through now 2014 at 50%, except for a very small period in there between September 2010 through December 2011, where it was actually 100% bonus depreciation. But as I said, that's ended as of 2014. Bonus is really beneficial to a lot of taxpayers for a number of reasons, and it's mostly because any business type could take it. There is no income limitations for it. It doesn't have to be active income, which, as we'll talk about, contrasting with Section 179. You don't even need to have income in general. You could be in a loss position and still take bonus depreciation. There's no maximum in the amount of depreciation you can take in a year when you're talking about bonus. The one restriction, besides having to be tangible personal property, the one restriction that I think taxpayers tend to forget about is that it has to be a brand new asset, meaning you can't purchase a asset that was used by another taxpayer in which they resold it to you. And then when we contrast that to Section 179, you can actually take 179 on an asset that's been used by a previous taxpayer as long as it's not a related party that is selling you that asset. 179 gives a little more flexibility in terms of the depreciation that can be taken in the first year. You can fully expense the entire asset that qualifies, or you can even just expense part of that asset. So you could really play and get taxable income to where you would like it with Section 179 a lot easier than you can with bonus depreciation. Like I said, it doesn't have to be a brand new asset, but 179 is definitely a little more restrictive than bonus depreciation. It eliminates a number of taxpayers from being able to take it. You have to have active earned income, meaning most rental real estate partnerships would not qualify for Section 179. I know a lot of our contractors have rental real estate entities as part of their operating groups. Bonus is eligible for those rentals, but not 179. And you have to have income. And it's got to be you can only put into place a certain amount of assets during the year. If you put in too many, in the case of 179, it would be phased out. So in 2014, you could get a maximum deduction of $500,000 of Section 179, but the phase out of qualifying assets placed in service began at $2 million. So at 2.5, it's a dollar for dollar phase out. So at 2.5 million, you would be completely eliminated from being able to take 179. Where it stands now, it's reverted back to when 179 came into play. For 2015, you can only get $25,000 deduction for 179, and the phase out begins at $200,000. So not only is it much more restrictive on the taxpayers that can take Section 179, even if you can take 179, we're talking about a very small benefit compared to previous years.
Now, Mike, question for you here, Mike. Now, we've talked about where we were in 2014 and where we're at in 2015, having that bonus depreciation has gone away and Section 179 has gone back to previous limits. Why don't you talk a little bit about, and maybe you're going to talk about this, about where this stands in Congress, because I know from a congressional standpoint, at least I think within the United States House, I believe the House Finance Committee has reviewed this and it has made a recommendation to go to the full House and Senate to have this restored back to 2014 limits and even make it a longer-term tax benefit of 2 years.
Yeah, Dave, you're exactly right. Both the Senate and the House have introduced legislation. It's stalled. There's been other things that have been passed, but there is strong bipartisan support for both bonus depreciation and Section 179 being restored to what it was in 2014. I would add that, we've been down this road a lot the last 4 years. In fact, I think it was each of the last 4 years we've come down to either last minute or pretty close to that. A couple years ago, if you recall, we had the fiscal cliff. We had legislation passing in January 2nd, retroactive to the previous January. And then even last year, we had the tax extenders bill being passed in mid-December, retroactive to January. As a tax practitioner, it's very frustrating because we try to help our clients prepare for what their tax liability will be throughout the year. And without being confident whether we'll have bonus depreciation or Section 179, it really changes how we have to run our calculations and really have to run a couple different scenarios for clients. The real negative effect, though, with bonus and 179 aren't passed this year, besides not being able to take that accelerated depreciation. It's really for businesses that have taken that in previous years. They've been able to take that accelerated depreciation. They no longer have that tax basis available to them, and they could be looking at some very unfavorable book-to-tax adjustments because they still have the book basis but not the tax basis. So that's just something to keep in mind. Even if bonus and 179 are extended, if you're not placing more assets into service in 2015, still going to have a negative effect on your tax liabilities.
Just to add on that, Mike, I hear from my clients a lot in regards to they want to know about, okay, where does Section 179 stand? Where does bonus depreciation stand? What can I take? I'm buying this new equipment this year. Can I put it into place? with Section 179 and bonus depreciation. And, they're all reasonable questions and things that you say, yes, you can definitely put that into place. I think the one thing that that businesses sometimes miss the boat on is the cash flow impact into the future of the accelerated depreciation methods, and the fact that really all you're really doing is deferring the tax into the future, and you're going to ultimately have a cash flow impact at some point in time unless you continue to keep putting that equipment into service or new equipment into service every year. So one of the things you should probably do is just make sure you have, as a business, you've looked at what your requirements are for capital equipment and what you need to put into service over longer periods of time to make sure that you can take the appropriate advantage of those matters without having negative cash flow impacts to your business.
That's exactly right, Dave. I mean, we love delivering great news to our clients in the first year of placing an asset into service, saying, "Oh, you can get 50% or even up to 100% deduction in the year placed in service." Really hate coming back to them the next year and saying, "Well, you don't really have as much depreciation available for tax as you do book. So even though your book income might only be $50,000, you're looking at $150,000 of tax liability." And that's something clients and taxpayers don't like to hear too often. So as long as they're aware of it when you are taking the accelerated depreciation, it is a temporary adjustment. A couple of ones that I'm going to move into, though, once we talk about credits and deductions, there are permanent tax savings involved with these, unlike the accelerated depreciation. The R&D tax credit, research and development, has been extremely beneficial for contractors over the past few years. A number of our clients have really benefited from this. Even we've been very surprised with the results that they've gotten from some of their studies that they've done. Of anything that we've talked about today or will talk about, this probably has the strongest bipartisan support in Congress to be passed and extended retroactively. So it's more of a matter of when and not if at this point for R&D, of when it will be extended, and when it comes back, it might actually be better than it currently or where it was when it expired in 2014. 2014 and previous years, research and development tax credit was not able to be utilized against AMT. So if a taxpayer was in AMT or very close to AMT, there was no benefit for that taxpayer, and that eliminated quite a large base of contractors and other entities that might have qualified for it and gotten good results, but really could not be able to utilize the credit. 2010 was the only year that we could actually take the R&D credit against AMT. So that would be very nice if that does come into play where AMT limitation is limited or eliminated. You also have to have income tax to be able to use the R&D credit. There is a proposal out there right now in the Senate Finance Committee to actually make a portion of this R&D credit refundable, meaning if you are a startup entity with 5 years or less and you have payroll taxes, you can actually utilize $250,000 of the R&D credit against payroll taxes. And that would be a first if that were to come into play. Lastly, it could become permanent, and that would be very nice. And then we don't have to have this conversation every single year of it's expired, but it might come back. In fact, if everything was permanent, that'd be great as well. But R&D, that's the one that always gets this as the strongest conversation of actually becoming permanent. Work opportunity tax credit, I don't see many contractors in our base getting this. It's mostly retailers that I've seen, but it is available for any type of business entity that targets hiring employees in certain specific areas, such as ones that were unemployed or veterans or even ex-felons. Section 179D, this is a great benefit to contractors and architects. You get, and I don't want you to get confused comparing Section 179D to Section 179. They're two different things. 179D is for business efficiency improvements to a building. And for an entity that has this performed on their building, they can actually get an accelerated depreciation. Again, just temporary, but where it's really good is for a permanent benefit for contractors, architects, and building designers that do work for government buildings. So if, for instance, if a contractor were to do a lighting retrofit for a state university's dormitory, that would qualify. The government entity cannot use the 179D. They can actually pass it along to the contractor, and the contractor can get those permanent savings on their tax return. There is a proposal in the Senate Finance Committee that would extend the same benefit to work done for 501c3 nonprofit organizations, which would open the door up for a lot of other contractors and architects and building designers to receive the 179D. The last thing I want to quickly highlight, and this is a done deal, unlike the other things that I'm talking about today. This has been passed, and you gotta love how Congress slips in these little things to do into bills that seemingly have nothing to do with the bill themselves. This is the highway funding bill, and in it, it's kind of revolutionized the tax industry because, and it's received actually very little fanfare in doing so. The partnership and C Corp tax return due dates will now change beginning with the 2016 tax year. So if we think spring 2017 when we start filing those returns. Partnerships are currently due, if we think of it in a calendar year, partnerships are due April 15th. C corporations are due March 15th. Those entities will switch due dates. So C corporations will be due April 15th, and partnerships will be due March 15th, which is the same date as S corporations are currently due. And that actually makes a lot of sense. Partnerships and S corporations are both pass-through entities, meaning income is passed through directly to the individual shareholders or partners. And to allow a month in between the due dates of individual tax returns and the pass-through entities will give taxpayers and practitioners enough time to get those K-1s and enter those information. C corporations don't directly pass their income to individuals, so their due date doesn't necessarily need to correspond. If partnerships and C corps then extend their tax returns, they'll be due September 15th, or at least for a while. That'll change in approximately 10 years, but we'll talk about that closer to that time. So if you extend, the current due date is right now for both partnerships and C corporations is September 15th. So by extending, the new bill will actually not change anything in that regards.
Mike, just out of curiosity, just your opinion, by moving the partnership returns from April 15th to March 15th, do you anticipate that there'll be more extensions of returns? Because, as you said, most of that income is pass-through income to the shareholder, and it gets reported on their personal return. If they want to have their personal return done by April 15th, that's still to be able to get the partnership return done and the S corporation returns done by March 15th. Sometimes is a tight window, and you might see that, at least from my experience has been a lot of times S corporations get extended at March 15th, but they're finalized and completed at April 15th with the personal return.
Yeah, that's true. I mean, really, extending a return never extends the payment due date. So when you we do often extend S corporations past March 15th because S corporations themselves don't pay any taxes. Same thing with a partnership. So it will probably be pretty common for partnerships to be extended, but still the returns to be done prior to April 15th so that the individuals who actually do pay the tax don't end up having to pay.
It makes sense to me that you would put the pass-through entities together like that to both file at the same time than what we currently have what we previously had with S corporations on March 15th and the partnerships on April 15th. I mean, it's pass-through income. It's going to go to your shareholder return, and you're going to have to pick it up. So you might as well have this returns done at the same time.
Exactly. And the AICPA has really been pushing for this the last several years, and Congress slipped it in somehow into a highway funding bill, but we'll take it.
Mike, thank you very much. So the final section today is the most exciting section of this whole presentation. We're going to talk about the construction economic trends that we're seeing out there right now. And I'm going to move this on to the next slide there. So what we're going to do here today to just kind of look at where we're at in the construction market today and what the forecast in the future is we're going to look at a couple key trends and economic indicators that are out there that are used widely in the construction industry. Those economic indicators are the CONFIDEX quarterly reading, the Architectural Billing Index, the FMI Construction Outlook Report, the ENR Construction Industry Confidence Index, and the Associated Builders and Contractors Backlog Indicator. So before we get into these, each of these different economic indicators, let's just kind of talk about what to expect as we go through reviewing these economic indicators from a very macro or high level. The first thing is that as we go through these economic indicators, the results somewhat vary. You're going to see that some of the indicators show steady positive growth, some show more robust growth in the construction market. But the one thing that all the indicators appear to be showing is that the construction market's moving in a direction that's positive, in an upbeat direction, in a direction that is showing that we're definitely into full recovery within the construction industry. We're also going to see that within the recovery, that most industries, construction types, and also just different areas of the country are showing solid growth in the construction market. Also, the final thing we're going to look at is the long-term forecast for the construction market. And most of these economic indicators are going to show us that 2015 looks as if it will end as a very steady growth period in the construction market, and that should show that continued steady growth into 2016. After that, it's up in the air. We're not sure exactly where it's going to go, and most economists will tell you that they don't want to go past 2016 because of just other indices within the economy itself. So the first one we're going to look at is the CONFIDEX quarterly reading. And the CONFIDEX quarterly reading is done by CFMA, which is a Construction Financial Management Association. And what they do there is they do a survey of CFOs that have businesses in the commercial construction sector. And CFMA sends us out to randomly about 300 different CFOs within their network to kind of just feel them in regards to what they think the commercial construction market looks like and how their commercial construction company is doing. So what we're going to do is here on this first slide, on the left-hand side there, the slide is a graph, and it shows you the numbers for the CONFIDEX survey, and it runs from March of 2013 quarterly through the most recent quarter they did, which was June of 2015. And basically, as you look at that, you can say, well, it doesn't look like it's really changed all that much, and that is true. The way the confidence works is that they feel that anything above a rating of 120 usually shows that the market's in somewhat of a growth period. You can see from here we're talking about the market's been relatively steady from a confidence perspective, but from the CFOs over the last 2 years. The March 2013 reading was somewhat high, actually. It was the highest reading they had in that 2-year period, which is around 132. That reading dropped a little bit here in June of 2013 to about 128. But still, at the end of the day, the survey showing that most CFOs feel that at the end of the day, the market is growing, maybe not as brisk as they would want to see it grow, but the market is growing, and that there is some confidence that in the future that the construction market, at least in the commercial construction side, will continue to be somewhat robust. The next survey we're going to look at is the Architectural Billing Index, and this is done by the American Institute of Architects. And what this survey looks at, or what this billing index looks at, is it looks at billings by engineers and architects on business, and it's supposed to be a leading indicator of where new construction being put in place is going to occur within the next 9 to 12 months. The way this index reads is that they look at this index to say that a score that is the score that's below 50 on the index is showing that the market is somewhat in contraction, and anything that's above 50 will show that the market is in a growth stage. So on this slide here, we're going to look at the left-hand side. There is the graph of a couple different things. The bottom part of that graph, where you see the green and a little bit of the red there, is the actual billing index in and of itself. So you can see that the billing index as it was done in August of 2015 shows it's at 49.1. So that would reflect that maybe we have somewhat of a lag or a downward trend in regards to what's happening in the construction market. What I would do, though, tell you is I would focus on the top graph there that's in yellow there, and that is the inquiries that are being done of architects and engineers. That inquiry index is well above 60 and has continued to trend up since about November of 13. So while that continues to trend up, that inquiry index is saying that while we may not have engaged the architects or the engineers to do any type of review of a construction project. The inquiries are out there in regards to potential projects. So I kind of like to look at those both in conjunction. And while the inquiries has come down just a touch, overall at the end of the day, the inquiry mark is still very high, and you would be anticipate that you would see that the billing index will continue to increase over time as well. Some of the other readings on the billing index, just to kind of keep a just to kind of put in perspective, commercial industrial showed 49.7, again just slightly below the 50. Residential 49.5, just slightly below 50, and institutional at 53.7. That would make sense to me. Then institutional would be up because institutional is related to healthcare. Mostly would be healthcare construction, and knowing that the market that we're in the healthcare environment, that would make sense to me that would be up and continue to trend up. The next survey is the FMI Construction Outlook Report. And FMI, as we all know, is a pretty large management consulting and investment banking business that serves the engineering construction industry. And what the FMI looks for is they're looking at construction that's being put in place in three specific sectors. They're going to look at residential building, non-residential building, and non-building structure categories. And they're looking at these three different sectors in regards to construction put in place to help develop an economic forecast into the future. So on this next page, you'll see a really nice trend analysis there on the left-hand side that shows that in all three sectors, being both residential, non-residential, and total non-building structures, you can see that has continued to show growth since about 2010, all the way to their forecast period of 2019. This report's reporting that in 2015, they feel that the construction market will expand by about 5%. Now, that 5% is down a little bit from their initial forecast earlier in the year of 8%, but they're still forecasting that construction put in place for the year will be just north of $1 billion, which for the construction market and where it has been is pretty good. The Outlook also looked at what areas are the strongest performing area, and every area they looked at was they considered to be in a growth stage. Those areas being residential, manufacturing, construction, amusement, recreation, office, lodging, transportation. Most of these areas were showing continued growth in the construction market, and what they felt and they were forecasting or are forecasting positive growth. The one area that they're not forecasting positive growth or they're showing negative growth is in the power industry. And again, that kind of makes sense because if you look around, I mean, I was actually with Mike yesterday down in Philadelphia at the construction conference for the PICPA, and we were commenting on gas prices being $2.17, $2.19. That compression or suppression in gas prices is a good example of what we're talking about in the power market here. When you have declining prices like that, you're showing that there's more supply than demand, and with more supply and demand, you're not going to produce as much power, which means you're not going to have as much infrastructure growth of building wells, drilling for natural gas resources. I think we see that even in Pennsylvania right now, where in the northern tier, natural gas drilling has slowed down significantly because of the suppression in prices. So we're going to go on to the next one here, which is the ENR Construction Industry Confidence Index. And what this is another survey that's done where ENR will survey they'll survey executives and within their ENR network of about 6,000 firms that they represent, and they'll ask these executives, where do you think the market's going to be in the next 3 to 6 months? And also, where do you think it's going to be in the next 12 to 18 months? So they're looking for some more feedback from them from a short-term perspective as well as going into a long-term perspective. So on the left-hand side there, you're going to see this big number 78 that says that's what the confidence index is. Now, the confidence index works from 0 to 100. This index at 78 actually is the highest this index has ever been. So executives feel pretty upbeat and robust about where the construction industry is. If I was to look at that, though, from the perspective of grading it in a school grade, I mean, I'd say 78 is a high C. So maybe the market as a high C right now, moving into that low B range, is saying that things are moving up in a positive direction, but we still have room for growth. That's how I would read it, but anybody else can read it the way they want to read it. But again, and this is another index where executives have looked at this index and they feel again strongly that the market is definitely in a recovery stage, that the market's continuing to grow, and that they feel confident going into 2016 that the construction market will continue to show signs of full recovery, except in one area, and that's in the petroleum area. Petroleum, again, as we talked about earlier, being tied to the power industry, it would kind of make sense. Again, going back to what we talked about with the suppression in gas prices, the suppression in natural gas prices, that would make sense that you would probably see somewhat of a downtick in that area. But all other areas, executives feel pretty strongly that the market will continue to increase and that they feel confident going into 2016. The final economic indicator we want to talk about is Associated Builders and Contractors Construction Backlog Indicator, or their CBI. The construction backlog indicator is going to look at what is the amount of construction that's in backlog right now throughout the United States. And the indicator is going to look at construction by region. It's going to look at construction by different industries, whether it's commercial or institutional, industrial infrastructure. And it's going to look at it by company size. So we'll go to the next slide there. And on this next slide, on the left-hand side is a nice little graph of the United States, and it's broken out into 4 different sections: the Northeast, Middle States, South, and the West. So if you look in the middle there, on a year-over-year basis, if we're to look at Q2 of 2015 versus Q2 of 2014, the Middle States and the Southern states are showing relatively significant growth, where construction backlogs actually increased by almost a month. In the Middle States, it's increased from 6.42 to 7.33, and in the Southern states over that same time period, it's increased from 8.88 to 9.0. However, we also see in the Northeast and in the West, we have a decline in what is in backlog right now in the construction market. On the Northeast, it's down by about half a month, running from 9.36 to 8.85, but in the West it's down pretty significantly year over year, dropping 2.45 months from 9.22 to 6.77. So that's a pretty significant decrease in the Western states. Now on the graph on the right hand side, though, the graph on the right hand side looks at it by region, industry, and company size, just looking at the change from the first quarter analysis to the second quarter analysis. So if you looked at it on a quarter-by-quarter basis, it's just here in 2015, the story is a little bit different, because what the story is telling us is that on the western side, you can see that we see a growth of 22.2% in months of backlog, which is pretty significant. So it tells me that in the western United States, things are turning around in the construction market. The rest, middle states continues to be robust at 5.2%, and then Northeast and South had some change in the total amount of months of backlog, but not a lot, and it's really not that significant. On the industry side, commercial and institutional and infrastructure showed a little bit of a slip, but not a lot in regards to months of backlog. But on the heavy industrial side, it's up 7.6%, which is nearly half a month. So again, heavy industrial is showing us that market is showing some signs of real recovery and coming out of what happened in 2009 and 10 and is expanding and looks to expand into the future. And then from a company size perspective, all the different company sizes are showing positive growth in their backlogs, so that's a good sign indicator for companies in regards to having the backlog they need to have to go into winter months and into early spring months to be able to staff and to properly plan into the future. The last slide I have here is a slide from the PICPA's construction conference yesterday, and the economic forecaster, what's his name again, Mike? I can't remember. Aniban Basu, who has spoken at a number of different events that ABC has held and others. This is kind of his overall summary at the end of the day of what he's seeing in the market. I just kind of thought was a good one to put in there. It kind of sums everything up for you. The first thing he was saying is that the construction industry is kind of in the middle stage of its recovery, in that, there's 2016 looks positive as well. The other thing he was talking about is interest rates can still have a factor on construction growth, specifically in the non-residential and residential construction areas. Rise in interest rates obviously is going to cost more money, and we're not sure or unsure about what that means to those construction indices. Federal Reserve, being the ones who set the interest rates, are kind of in a no-win situation as they look at raising interest rates into the future and what that impact's going to be on the economy. He also talked a little bit about what he called black swan events, things that could have not just an impact on the construction industry, but could also have an impact on the economy as a whole. Things such as what might happen in Iran, the Iran-Israeli potential conflict, what's happening in Europe in regards to Europe debt crisis in Greece and other areas like that, contagia, Ebola, cyber, and EMP being electronic magnetic pulse, right? And then the last thing he talked about was, the market is still in a nervous standpoint, but really at the end of the day, when you look at all the different indicators in the market right now, there's really no reason for those that are in the market to be as nervous as they are, because companies are still profitable, still cash flowing. All of the economic indicators within different sectors show positive growth. So that's it for our presentation at this point in time. I'm going to turn it back over to Tyler, who's got a couple announcements. Tyler, outstanding on the announcements. Give yourself an A+ on that one. We do have a question that's come in here, and this one is for Mike Eby. Mike, I hope you're ready.
I'm ready.
Ready? It's like Jeopardy. Section 179D, how does an architect or contractor get the credit allocated to them? What if both ask the same government customer?
Yeah, when I saw that question pop up, I actually was kind of excited, because that is a big...
Whoa, back down now, guy. Back down.
As excited as a tax person can get. Yeah. But that can really be an issue for contractors and create some tension between them and their government entity customers. Now, very large government entities, they probably have a process in place for handling these, so they're used to dealing with this. But if you're doing work for a government entity that doesn't deal with 179D much, the contractor really needs to take the lead on this. So you got to get a signed statement from the government entity that you will get the credits allocated to you, because it is kind of a first come first serve. If there's another contractor or architect or building designer on that project, if they get to them first, they're going to get the credit, or I shouldn't say credit, the deduction, the 179D deduction for their return. Now, if you're working with or partnering with a firm, the government entity actually can make the decision to allocate that deduction to multiple contractors or engineers. So that might be a way to kind of go into the project and knowing that you could split it up. But again, if it's whoever comes first, so if someone could get the full deduction if they came in first and the government entity assigned it over to them. A good way to be proactive is to actually include that in your bid. You can actually lower your bid and kind of work with the government entity to ensure that they do give you a signed statement at the end of the project. I know you will probably need a independent engineer to come in and certify the project after it's over. And if you have this type of project, I definitely would encourage you to reach out to us. We have a partnering firm that we work with for a number of our clients that help get this situated, because you really don't want to mess up this, because it could really hurt a contract that you currently have.
All right, Mike, thank you very much. I think at this point we are out of time. I want to say on behalf of Mike Hoffner, Mike Eby, and myself that we thank you for listening to this webinar on the construction industry. We also invite you again, as Tyler said, to continue to tune into our webinars. We have one coming up here in November. And, I think it would be a really good one talking about South Dakota trust. If you have any trust concerns or anybody that's interested in having a trust in South Dakota, it'd be a great one to listen into. But overall, again, thank you very much for your time. We appreciate it. And that's it. Thank you very much.
Thank you once again for joining us for this presentation produced by McKonly and Asbury. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn more about our upcoming presentations by visiting us at www.macpas.com. Thanks again and have a great day.